Okay, so I'll start introducing myself, and I still have a minute. I'm Berna Karali. I'm a professor in the Department of Agriculture and Applied Economics at the University of Georgia. I am in the Athens campus, main campus. I teach futures and options class for senior undergraduate students. It's a split level class with master's level as well. And I do research on commodity price analysis using futures prices as my data. Okay, so today I'm going to give you kind of a crash course for the how to use futures contracts for price hedging purposes. I hope you had your coffee. It's going to be fast. I only have 20 minutes. So as we know, the goal of a producer is, grow the commodity and market it at a profitable price. However, there is uncertainty in the profit because of the yield variability. The weather will affect, or the pest or disease, they will affect the yield. And there's also uncertainty of the cost of production. But today we are going to focus on the uncertainty in the commodity price. As you can see, these are the cotton prices over time, how it fluctuates. And we're going to see why increasing crop prices is actually beneficial for producers, but then the falling prices are not good, right? You don't want to sell your crop at a lower price. And we're going to talk about how you can use futures contracts for price hedging. So these are the available hedging instruments, futures, forwards, and swaps. These actually establish a fixed price. Good thing about it is you actually reduce your downside risk, but it eliminates benefiting from upside potential. So options are unlike that, so it actually achieves a guaranteed floor price. It reduces your downside risk, but it also maintains the upside potential. I will be talking about the futures today, and after me, Dr. Robinson is going to give his take on the options. So what is a futures contract? Well, this is a financial instrument. It's actually legally binding. And when you enter into a long position, then you are promising to purchasing the underlying commodity sometime in the future. And if you are taking a short position, this time you are promising to sell the underlying commodity in the future. So the price, quantity, quality, quantity, quality, location, and the delivery time, these are all set by the exchange where the futures contracts are getting traded. The price is determined, of course, in the market with the, who is buying, with the demand and supply, basically. So the main futures contracts on cotton are traded on ICE. These are the specifications. It's the number 2 futures and the price quotations. And one contract stands for 50,000 pounds of cotton. And as you see, the exchange list all the quality accepted, deliverable origins, and locations as well. And we do have a couple different maturity months. These indicate March, May, July, October, and December. These will be when the contract ends trading. So then the intention is the physical delivery can happen after that, like in May, July, October, and December. So when we are facing this many maturity months different, which one do we choose to hedge our price risk? So you will naturally choose a delivery month that is as close as possible, but it will be expiring after your hedging horizon. So for instance, if you are going to be selling your crop in December, then you will be choosing a futures contract that will expire after December, so that once you sell your crop in the cash market, then you can go and close out your position, hedging position. But for instance, if you are going to be selling again in December, and if you choose a contract with March maturity, then you are exposed to the price risks from March to December. So that's why you like to choose a maturity month that is as close as possible, but later than your hedging horizon. And it's not true for cotton because there's already a futures contract, but for some of the commodities, there are no futures contract, like peanuts, for instance. So in that case, you will try to find a futures contract whose price movements are much more closely related to that commodity. That's called cross-hedging. So even though the futures contracts on cotton allow for physical delivery of cotton, that means if you had a long position, you are taking the delivery of cotton. If you are a short position as the producer, then you are making the delivery. Despite this possibility, the futures contracts do not end up with physical change of the commodity. Traders usually close out their position before the contract maturity because they prefer going through the physical delivery through their local market. As we saw, the locations are set by the exchange, and then the short position chooses the location where to deliver. They will always choose the weakest market. So about, I would say 1%, at most 1% of the futures contract end with physical delivery. So you do close it out. How do we close it out? Well, whatever position you open, long or short, then you do the exact opposite to close out that position. So for instance, if you took a long position on 2 May delivery cotton futures contract, to close it out, you will take a short position on that same delivery futures contract. It has to be, again, the same number of contracts to in May delivery. If you took a short position on 4 July maturity cotton futures, this time you will take a long position to close it out. That is important. You know, the maturity months have to match, the number of contracts have to match. Otherwise, you are opening a new position, right? So it has to be completely neutralize your existing position. So there is long and short hedges, and it all depends on what your cash market position is. So for the, in general, the hedging is you take the opposite position in the futures market, whatever you have in the cash market. So as a, for instance, the long hedge will be appropriate if the hedger is going to be purchasing a commodity in the future, right? So their cash market position currently is short. They are short of that commodity, and they will be taking, that's why the opposite, long position in a futures market. And for a short person who is going to be selling the underlying asset in the future, then their current position is long. They are long of that commodity. For cotton producers, then they are long of cotton. They will be selling that after harvest. So then they take exact opposite position in the future. So they take a short position. So this is a graph to show possible profit and loss from using the futures contract for hedging and for the short position, because I'm focusing here on producers' perspective. So then if this is the futures price at the time the hedge is placed, when we are closing our hedging position, we are taking the opposite, you know, we take a long position. If the price is lower, then this short hedger is going to have a profit. But if the futures price is higher when we are lifting our hedge, compared to when we initiated our hedge. So now we're taking a long position at a higher price compared to what we had with short. So then we are going to have a loss, okay? So this is a numerical example to demonstrate how this short hedge works. So we have a cotton grower, and they know that their crop will be ready to sell in early September, and they expect to have 150,000 pounds. and their price risk will be lower prices when they are ready to sell, right? So what if the cotton price falls? So to minimize this risk, they will take the opposite position in the futures. So the current cash position is long, so they will take a short position in the futures. If we are assuming expecting to hedge 100% of the crop, then we need to hedge 150,000 pounds. I just divided by the number of the size of one futures contract, that's 50,000 pounds. So that means I need to use 3 futures contract. And we will choose the October delivery because we will be selling in early September. So it has to, the contract has to expire after that. So the first available maturity is October for cotton. So then we will enter into a short position with 3 October delivery cotton futures now. And then after, I like to use a timeline here. So right now we will short futures contract, and then in September we will sell our crop in the local market. After that, we go ahead and take the opposite position to our futures position by going in long in those 3 October delivery futures contracts. So then these will, the futures market transactions cancel each other. Of course, we're going to look at the prices to see if we made a profit or loss on that. So let's suppose in January the spot price and October cotton prices are given like that, and then both of them are getting lower in September. It turned out to be, they dropped a little bit. So now, so what happens? So in the futures market, this grower will gain about $2,400 in total because they had a short position at the price of 65.07. That means they promised to sell the underlying cotton at that price, and they are closing out. That means they are promising to buy cotton at 63.50. So that's why there is a profit per pound. When we multiply it with the total number of pounds, we have about $2,400 gain on futures. So in the cash market, they sell to the local elevator, let's say, and they will receive the cash price in September. That's $65.40. Again, in total, it's about $98,000. Because of the gain on the futures, we actually add that to your sales revenue. So it's $100,455. And if I just divide it by the total number of pounds to find the unit price, I find that $66.97. So that means that price is higher than the spot price in September, which is $65.40. As you can see, by using futures contracts in this situation, it did protect the short hedger against the falling prices, right? Both spot price and futures price fell, but the net selling price in the end is higher than what the spot price is because of the gain on the futures. So now I'm going to reverse this. Now the prices are actually increasing in September, so both spot and futures. In this case, we are going to have a loss on the futures. And our total, our revenue in the cash market from the cotton sale is higher. But because of the loss on the futures, our total sales revenue got lower. If I divide it again by the total number of pounds, this time I find that the unit price is actually lower than what the spot price is in September. So as you can see, this is the part I'm saying. So using futures is good for protecting yourself against decreasing prices. But for the increasing prices, you actually incurred a loss on the futures, right? So that's why the futures is actually not allowing you to maintain the upside potential. So there is also important concept basis. This is the difference between the cash price and the futures price. So it varies over time, and it can get stronger. So that's called strengthening of basis. So cash prices increase relative to the futures, or it can get weaker. So this time cash prices decrease relative to the futures. So while this strengthening basis will be an advantage for a short hedger, like a producer who is going to be selling the commodity, the weakening basis is an advantage for a long hedger who will be purchasing the underlying asset in the future. So how you can use the basis for establishing your expected selling price or purchasing price is you can first establish your expected selling price. So you have the futures price at the time the hedge is placed, and then you add the expected basis to that at the time the hedge is placed. Of course, the realized prices will be different depending on what happened. So you can find the realized price from hedging with the cash price at the time you sell your cotton in the local market, plus the gain and loss on the futures contract. That's the example we just did, how we calculated. But there's an alternative way you can reach the same realized price. You can just add the futures price at the time the hedge is placed, plus the actual basis. So what happened between the difference between spot price and the futures price when you are closing out your hedging position. So we'll do an example. Again, this time this producer is planning to sell in December, and the December cotton futures price is 64.41. The cash price in the area is usually 350 under the December futures. So that means the expected basis, spot price minus December, is negative 350. So then we can find the expected selling price by adding the futures price and the expected basis. So as a producer, we expect to sell our crop at 691 with this. But if the basis, that's what we did in the previous slide. If the basis stays the same, 350, let's say the futures price ended up being 632 in December. So we take the long position to close out our futures position there. That implies with the 632 futures price with 350, negative 350 basis, implies a cash price of 56.82. So then we do have a gain on the futures, and the cash price, I say here loss, but it's not an incurred loss compared to the expected price. So it is also low, but it's 1-to-1. So because the basis did not change, it turned out to be exactly what we expected. So that's why your net selling price is exactly the same as your expected price. So what if the basis actually, and this is another way to calculate it, we can add the futures price at the time we started our hedge plus the basis at the time we are lifting our hedge, negative 350. So what if the basis gets weaker? In this case, let's suppose it is 450 under instead of 350. It became more negative. So then that will imply a lower cash price, 55.82. We still have gain on the futures market, but this time the change in the cash price compared to what we expected is much larger than the gain on the futures. So that's why we are going to have a lower expected, a net selling price that is lower than what we expected. So as you can see here, the weaker than expected basis actually reduces the net selling price for a short hedger. So I will flip this, and this time we'll do a strengthening of basis, and the basis is increased. So instead of negative 350, now it's negative 250. So that implies a cash price of 57.82, and we still have the gain on the futures, but now the loss on the cash is smaller than the gain on the futures. So that's why our net selling price is going to be higher than what we expected. So a strengthening basis that's why it's an advantage for a short hedger. So one last thing is you can also, there's also storage hedge, and this is you have the commodity in storage. You don't want to sell it this season. Maybe it is because of the tax reasons, or maybe it needs to dry and all that stuff. And the market conditions actually provide you some profit by doing so. So in that case, then this type of storage hedge will work best if the carrying charges are large and positive. And the deferred futures contracts, that means they have the farther out delivery maturity time, their prices are higher than the nearby contracts. So, and the hedger is expecting the basis to increase. So I'll give a very brief example here. So let's say December cotton futures price is 64, that's after harvest, and the harvest basis is -5. And that means expected harvest cotton price, spot price is 59. And then the May delivery, that is farther out than the December, futures price is 75 cents per pound, and you expect the basis to be in May -2. It's actually larger, it's stronger than what it is in December. That implies an expected spot price of 73. So now the decision is, do you want to sell at harvest for 59 cents per pound, or store it and sell it in May for 73, right? Because that's, is there an incentive to do that? So what you can do is you will look at the difference between the futures prices, December and May delivery futures prices. There is a 9 cent per pound difference, and also the expected gain on the basis. So the basis is -5 in December, but it is becoming -2. That's what you are expecting. So 3 cents. So then the gross storage return is 12 cents. So what you will need to do is you will need to compare that to the cost of storage cotton from January to May. And that will tell you, is a storage hedge profitable or not? So the takeaway is hedging can greatly reduce the price risk, but does not guarantee a profit. Making the profit is not really the purpose of hedging. And of course, all these hedging decisions still need to account for the yield variability and market outlook. So that's all I have.
About 4 minutes for questions. You mentioned the yield variability.
Mm-hmm.
So one of the things that I've always struggled with is knowing how many contracts to buy, because you said in this example it's 150,000 pounds.
Yeah.
But I may not make it 75,000 pounds.
Yeah.
So, I mean, I don't know how you.
So there is, it's a very good point. So there is, I actually teach, yesterday in my class I mentioned this, because you don't, hedging is in real life, it's not as simple as this sounds, right? Because we don't know how much crop we're gonna get. So in those situations, and again, I was using in the example to make our life easier, 1-to-1, I'm hedging 100%. So you still, you can still use the futures contracts, but then you have some rough estimate, what was your previous year's crop yield, and then you can use that maybe as a judgment. And then, you have some approximate amount you wait, and it's just figuring out, how many contracts you're going to be trading. But there's also, I'm not specialized in crop insurance, but there's also crop insurance available for producers that will protect you against yield variability, right? So that's, he will be talking about options, not really insurance, but that will be my take. You still, go, okay, I increase my acreage because cotton prices are higher, for instance. I expect to harvest this much more, but of course, there will be still that variability. But because you're not actually physically exchanging the commodity with futures, you're just trying to use that to fix your selling price. So that's why the amount doesn't really matter. So you might end up, there's also optimal hedge. I didn't go through here, but instead of hedging 100% of your cotton, maybe 70% is enough, right? So that's the point.
That's what I was wondering, if you better to be on the conservative side, well, I may not make 70% of what I usually do.
Yeah.
And then, but you're, depending on what the market does, if it's higher or if it's lower, and you don't come in there where you bought at, when I say bought, I mean the amount you bought.
Yeah.
And it's gonna affect that bottom line, right? I mean, because it's not one-to-one.
Yes, well, it will affect the, you can change the futures contract size, but the gain on the futures or loss on the futures will be how many contracts you got, right? So because that amount is fixed. But it will affect in these calculations, I think it was when I did the total, let's see, I think it was here, it will of course affect here, right? So that amount is going to be different. So it affects your cash market, how much revenue you get, because your yield is different than what you expected. But the gain or loss on the futures is fixed because the contract amount is fixed. So it will depend on the number of contracts.
Robinson from Texas A&M, and they asked me to talk about options, which is a more complicated subject and less perfect subject than what we just heard. There we go. All right. So I think we should start off with a joke. This is the shortest joke you'll ever hear, so you got to be right up ready to pay attention or you'll miss the punchline. All right, here we go. Two Irish guys are walking out of a bar. Did you get it? That's it. The joke is that they're walking out. All right, sorry. He wants me to stand here. All right. All right, so ag economists, as I've just demonstrated, are not known for their stand-up comedy. We are known for spending hours and hours and hours talking about futures and options. I'm an extension person, and over my career, since the 80s, since options have been available to cotton farmers, extension people and other people in the industry, Joe O'Neill, who ran the New York Cotton Exchange, would put on these workshops, and we talk about, seriously, we would talk for hours about the role of options, the history of futures, how options strategies are similar to futures but different, the advantages and disadvantages. We'd go on and on and on. I'm not doing that today. I don't have time, and I don't really think it's relevant. If it ever was relevant, the world has changed. The world of risk management has changed. It doesn't look like this, as much as we would assume and put on programs that look like this. What it looks like is this. This is risk management in agriculture and in the cotton world specifically. These are, if you're don't recognize these government acronyms, these are all insurance programs and farm bill programs. By Title I, I mean ARC and PLC, which are really insurance, to me, insurance-looking types of programs in the way that they work, ARC and PLC. Title 11 is the insurance, crop insurance, which is yield protection and it's revenue protection, but now it's also stacks standalone or stacks as an add-on or SCO or ECO, or I probably forgot a few. And as you can kind of look at what's laid out here, there are possible different combinations, and it's kind of on you to figure out, well, what complicated combination of stuff is best for me in terms of coverage and in terms of cost. Now, I submit to you the modern role of options is simply one more thing to complicate this chart that I've got here. It's one more thing to consider. It's one more thing that might combine with something and substitute for something else. That's really the only point I'm here to make this morning. I'm going to give a couple of examples where I think using an options approach combined with something else might be better than one of these combinations. So that's the world that we're in. And so let's just move on. This is the point I just made. The only thing I want you to think about, this isn't a conventional presentation on options, as you've probably already guessed. I'm not going to tell you how or why options work as insurance. I'm just going to assert it, and trust me, an option strategy is simply price insurance. Just think of it that way, pure and simple. It's either insurance against falling prices when you haven't sold your crop yet, or it's insurance against rising prices when you've already sold your crop and you might miss out on an opportunity. Think of it as price insurance. You pay a premium up front. You may or may not collect on the insurance, just like any other insurance product. That's how I want you to think about options. And the good thing about them, the beneficial, useful thing about them is that they are flexible and they let you insure a specified range of prices, a specified range that you might be exposed to price risk. Why wouldn't you be exposed to price risk more broadly? Because you get price protection from the loan rate. You get price protection from your revenue policy if you have one. You get price protection from other things. So you don't need wholesale price protection the way we would assume in a classroom demonstration about put options benefit from falling prices. Well, you don't need to protect against all falling prices. There's just little selective ranges. And so I'm going to give 3 examples in the time I have that show I think what are the relevant things that you need to protect and how you can protect them with options. One is using put options. Put options are downside price insurance. Don't think of them any more than that. Combined with yield protection, which is the non-revenue product, the old crop insurance. You can combine put options with yield protection and you can hedge against falling gross revenue. Now you could do that with an RP policy. You could do it with an enhanced RP policy. If you have SCO and ECO, you can cover more of that topside shallow loss, whatever they call it. Costs a lot if you do that. So the question in my mind is doing this sort of as a do-it-yourself revenue policy better than that? And the answer is I don't know which is better, but one of them is probably better. One of them is probably cheaper. You can get the same coverage and maybe do it more cheaply doing this way or this way. This exists because of using options, so I'm going to give you that example. And then I'm going to give an example of protecting the erosion of your PLC payment if prices actually go up. We could do that with a call spread. Call options are simply insurance against being hurt by rising prices. And then I'll think of something outlandish like dollar cotton and how you could protect yourself from a missed opportunity if the market ever went up again, drastically up. So here's my first example. Do-it-yourself revenue insurance. Revenue protection you're all probably familiar with. We've had the revenue policies now for a while. They protect you against falling gross revenue. If you have a 65 or 70% revenue policy, you're giving up a lot of potential loss if it falls from 100% down to your coverage level. So they've come up here recently with these shallow loss add-ons, which are not exactly apples to apples add-ons because they're area-wide policies, but I'm thinking of stacks, I'm thinking of ECO and SCO. You can add those onto a revenue policy and get protection from 85% down or 90% down. Okay, well, you can do the same thing with options combined with a cheaper yield policy. So this is an example of how to do that. First of all, let me make the point, you don't need protection against falling prices below a certain level. That level's the loan rate. You get, Uncle Sam is giving you a free put option at the loan rate, which would be 55 cents, I think, for the 26 crop. So you've got downside protection way down there and down. What you need is protection against falling prices from kind of where we are or where we might be in a month down to the loan rate. That's what you need. So that upper range is up to you. I'm going to do an example here where the upper range is going to be 90% of what I'm assuming is the projected base price. I didn't want to be doom and gloom, and you're going to have an outlook at 9 o'clock, and it may not make you happy. So I'm going to assume that the market is going to go up in the next month. I'm going to assume your crop insurance is January 15 to February 15 is your window. Okay. So I'm going to assume that that the market is going to go up, that they're going to resolve tariff and trade issues, and that the economy is going to pick up, and that the speculators that are currently short the market are going to buy it back. And I'm going to assume that your insurance price turns out to be 72 cents. For this example, your base price, I'm just purely guessing, is going to be at a nice 72 cents. 90% of 72 is about 65 cents. So that gives us the range that we need to protect. The relevant range of exposure to downside price risk is really from there, 65 cents to the loan rate, okay? And options are a nice, easy way to hedge against the decline of a specified price range. So how could we do that? And so if we do that, you can marry it to an enhanced yield policy, and that might be equivalent, kind of a do-it-yourself version of revenue protection with these add-ons. So here's the way you would do that. Just again, trust me, we don't have time for me to actually tell you exactly how and why this would operate and what the risks are and what the disadvantages are. Don't have time to do that. They all exist. If you were doing options, you'd need more background knowledge, and if you were doing options, you need a good futures broker who can help you put these positions on and manage them. I'm taking all that for granted and just say, here's how you could use a put spread, which is just insuring against being hurt from a decline from 65 to 55. You would do it this way. The other day, that spread, you'd have to pay 1.55 cents per pound on a 50,000 pound contract. That's $1,800 or something. You're buying a put, you're selling another put, so you're paying this, you're putting this back in your pocket. Here's your net outlay on this protection for falling prices in a certain range. And if you did that and combined it with a yield policy, that may or may not be a cheaper approach to hedging revenue from 90% down than it would using an RP policy. It remains to be seen, but that's one role of using options as a strategy for revenue insurance purposes. While we're talking about, I've already mentioned stacks and SCO and ECO, and I didn't define them and I didn't explain them, and that wasn't very nice of me. So I'm going to put it off on some colleagues of mine. Take a picture of this slide. This is a tool. You go to this website. That the Ag and Food Policy Center at A&M has an online tool. I said, I'm going to Georgia to advertise your tool. Can I do that? And they said, yes, please. Tell those Georgia growers that this should work for them. Go online. If you have trouble operating it or have questions about it, there's contact info on that website, and you can call them and you can tell them that I said that they should answer your questions, even though you don't pay taxes in Texas to support this. Anyway, this is more for making a decision about what's better, stacks or SCO or ECO or combinations thereof. So that's that. All right, next question. What if we have I'm thinking positive here. What if we have a rally in the market? Are there any risks to having a rally in the market? It would be nice to be able to sell fiscal cotton. It would have been nice this year. We had good yields, even in Texas, but the price is killing them. So yeah, so the advantage of a meaningful rally into the mid-80s, we'd be able to sell cotton higher, but it would be bad in one sense. You have a financial asset right now. If you have seed cotton base, then you have a financial asset in the form of a positive PLC payment rate. And if the market rallies to the 80s, guess what? That PLC payment rate is probably going to go to zero. You can protect yourself against that. Again, using options, which are handy to construct price protection over a specified range of prices. The range of prices that we're interested in now would be where we are now up to about the mid-80s. That's where the PLC payment rate would go away. Again, I'm not explaining a whole bunch of stuff about the PLC and the payment rate and combining seed cotton, the combination of cottonseed prices and lint prices that give you the seed cotton price. I'm ignoring all that for this example. I don't have time to explain it. But you can protect yourself against a rise in the lint price by doing the same approach I was talking about before. You buy insurance against rising prices would be a call option. You buy a call option, you could pay that out of pocket. You can put this back in your pocket by selling the level of protection that you don't need, and above would be selling about an 85 call, buying a 70 call. The net outlay would be 2.3 cents over 50,000 pounds. I don't do math in public, but that's a couple $1,000 to buy 100 bales worth of coverage, one call option contract. And if you did that, you could, again, give yourself protection. Now, do you need to do that? I'm certainly not recommending that. I don't use the word recommend either. The question is, do you need that as insurance? And you approach that like any other insurance question. What's the risk of a rising market? You can go here at 9 o'clock, hear an outlook, and my personal outlook is that I don't, if the market shoots up unexpectedly for the 26 season, if it happens, I bet it would come up and come right down. I don't know that it would matter that much to making your PLC payment go away, because I don't think it would last all season long and be part of the marketing year average price. I'm just guessing. So you have to make a judgment whether this is a risk that's worth insuring, just like you do with any other form of insurance, any other financial risk. Last example, I'm calling it Protection for Dollar Cotton, which is a strange title, maybe protection of dollar cotton. But the last time, anybody remember the last time cotton was $1? Early 2024. Why was cotton $1? Because China came in and imported 3 times, they imported 15 million bales. Right now they're importing 5. The unexpected import demand from China made the market shoot up. All right, I'm not saying that's going to happen again, but if it did, and if the market shot up unexpectedly and was sitting there at $1, what risk do you face if that was to happen? Well, let me put it this way. How could you grab onto the benefit of dollar cotton and not let it slip away? You could contract some, somewhat risky, but you could do a cash contract at high prices. Obviously, you can always do that. But is there any protection, particularly from the farm program, is there any protection that would pay you if the prices start going down? The answer is no, at least not from PLC, because again, the PLC payment rate goes to 0 somewhere in the low to mid 80s. So if cotton goes to $1, it can fall from $1 all the way back down, and you're just going to sit there and watch it happen, and you're not going to get anything out of the farm program to compensate you for the loss of an opportunity of high prices above the reference price. So again, this is a role for an option spread to protect a specified range of prices, and this is how we do it. Now this is the actual cost of these options the other day. When the futures are at 69, these are outrageously and unrealistically expensive. But if the futures price was $1, this would be a much more affordable thing. Again, you'd be paying for buying the put. You'd be paying for that, but selling the put for the protection you don't need further down. You'd be paying that out. You'd be putting that back in your pocket. This would be your net outlay. If the market was at $1, this would be more meaningful and more affordable. All right, those were my 3 examples. I think I've got a little bit of time to talk and answer any questions you might have. That was real fast. If you thought the first thing was a joke, then I was going to say I have another joke for you. You got to be ready. Here it comes. Bonnie and Clyde are walking into a bar. You get it? It wasn't a bar, it was a BAR. And they weren't walking. All right, that's it. My contact info is there, and does anybody have a question about my rapid and confusing presentation? I'm curious, how many growers in the room have used futures and options at all in any way? All right, quite a number. The futures part of it, I would say, I will take a wild guess, 99% of every physical bale that somebody ever bought from you was hedged in the futures market. It just wasn't hedged by you. The big merchant shippers use the futures market for everything, even the co-ops that buy from you and sell to big merchants. They all cover themselves and protect themselves. That's how they can afford to go out on a limb and offer you a cash contract or an on-call contract. So the futures are essential to the operation of the cotton market, even if growers don't do it directly. Any questions, ideas, complaints, issues anybody has while we're on the subject of hedging or risk management?
Two really complicated, two very, very brief discussions on two very complicated topics.
Yes. Very brief. Back home in the heyday of talking about hedging, we would put on 8-day workshops. And we'd go over futures and how they work and options, how they work. We'd do that every session. And it was like learning French. Just do it again and again and again and again. Most of the growers that would come to those meetings had previously just been in the seasonal pool, which we have one in Texas, and they wanted more hands-on, they wanted more control, so those were our customers. We've got 5 minutes left. Yes, ma'am.
If we want to start hedging, how, where to look first?
You need to find a futures broker, hopefully one who's knowledgeable about agriculture and hopefully about cotton specifically. You'll want to sign a stack of papers about that thick. To open an account, you'd have to put up an initial deposit of funds to show that you're serious and are capable of taking financially risky positions. Don't know what else to tell you. There are fewer and fewer ag-focused, hedging-focused futures brokers. In my world, the ones that worked with ag a lot of them have retired, but the ones that are still there are working with rich investor clients in Dallas. They're not working with farmers about hedging because they get more business from rich investors in Dallas who simply want to get into commodities, like they're into stocks and bonds and they want to diversify into commodities.
And those guys want to deal with hundreds and thousands of
Yeah,
contracts at a time,
yeah,
not one and two and
not your little,
Right.
to cover your little crop. That's not worth my time. That won't keep me, the broker, in business. Be fair to them. It just won't keep them in business.
Have either of y'all personally used futures or options yourself?
Yeah, I did. Commodities markets are a heck of a lot more volatile than the S&P 500. And I don't have a crop to back it up, so I was just a pure speculator. So I quit that.
Right. Understandable.
Yeah. Any other thoughts, questions, things that we didn't have time to present but wish we had?
A question to the audience is this some topic you are interested in dive deeper? Like I'm trying to see for the demand in like an 8-day workshop of futures and options. That's something of interest.
Having told you about it, since COVID, it seems to us that people's schedules, they prefer shorter venues. We haven't had much demand for the massive 8-day type of workshop. We're lucky if we can put on a 2-day workshop, and that's what we're doing now, 2-day workshops where we focus on crop insurance, policy stuff, and we give a lot of outlook. But even then, I don't get into the hedging, how to develop a hedging strategy. What we do is what I just talked about, how to incorporate options and hedging sort of into the insurance and into the policy choices.
I think something like that's like Field of Dreams. If you build it, become it. You really don't know who's interested unless you might get Adrian to say hey and Tim to say hey up there, but when you put something together, maybe not 8 days, but that's when you find out. It's a lot of work if nobody wants it, but that's when you really find out.
Yeah. Cotton Incorporated used to sponsor hedging workshops. So we would do one in Memphis. I think we did maybe one over here in the southeast somewhere. But most of the time we do them in Memphis and Lubbock, and I think that was it.
So I got a question, and that's not my cop. Did you make that joke up about Bonnie and Clyde, or did you find that somewhere? I would never have made a connection between Bonnie and Clyde and walking into a bar.
I didn't make it up. I'm not that talented.
That was pretty good. I had not thought of a bar in that way.
I have a question. Have options gotten more expensive over the years? Because it seems to me they have. It seems to me like in the 80s they were cheaper for the same. I'm talking about if you take the same time.
I would say they got a lot more expensive. There was a period of time. It was in that time, 2008, when the market went nuts. The volatility of that made options twice and 3 times as expensive as what we were used to. Sorry. That means my time is out. So when the market, whenever there's a real volatile period, they'll get more expensive. Right now, the market has been flat for 2 years, and options are probably the cheapest they've been since in a long time. So it's not like machinery costs that just trend up and up and up forever. It's just depending. It goes up and down with volatility.
Volatility and also underlying commodity price, right? So it also depends on the strike price and what the futures
Right.
trading.
If
They are changing.
you'd have to say for the same coverage level, for the same strike price. Good
That's what I
point.
was saying. The same everything.
Yeah.
Seemed like
Then I'd say it's mostly a function and time value and all that stuff. So if you can boil it down to just differences in volatility, then you can see, yeah, options are more expensive in a volatile period or not. All right, well, thanks for coming. We've got another session with Outlook and other economic considerations coming up next.